I think we're going to go ahead and get started. You want to have a seat? So, good morning again. It's still morning, 11:30. I would like to add my warm welcome to that of President Armstrong's and Dean Tamara Lawson and the President of our Tax Law Society, Kaylee Baby, to you, and welcome you warmly to St. Thomas University School of Law. I would like to express a very special thanks to our alumni who are here today in attendance, and welcome you back to your alma mater. You are all my students, and it's my distinct pleasure, to have you here today. Today I'm particularly proud because, again, here on this panel, just as the previous panel, all the presenters are my former students, all who went on to get LLMs in taxation, and are excellent lawyers here in South Florida and many nationally, and so, as you can imagine, I'm feeling like a proud father with a big family. But let's begin. As I'm sure you're all fully aware, the passing of what is commonly referred to as the Tax Cuts and Jobs Act, sometimes referred to as TCJA, has created, for almost all practitioners and taxpayers, many ambiguities and questions. Since it was signed into law by President Trump on December 22nd, 2017. For starters, even before it got to the president's desk, the first issue the Senate had to tackle was what they were going to name the act. So the actual and official name is an act to provide for reconciliation pursuant to Titles 2 and 5 of the current resolution on the budget for fiscal year 2018. That's actually the title of it. And, okay, I think he's going to get those up there in a second.
There you go.
And so, if you want to take a look at the acronym, that's it, at the bottom of that slide. I'm sure it's going to catch on real quickly and everybody will be using it. If anybody wants to win the raffle, you have to learn how to pronounce that acronym, okay? The one who gets it the most closest wins the prize, which is a nice bottle of wine. Okay, so today we're going to cover, for my presentation, some corporate and individual areas and updates since our symposium last year. So let's get started this morning with Section 301, redemptions and dividends. On March 26, 2019, the Treasury proposed a regulation to update Section 301 to reflect the statutory changes created by the Technical Miscellaneous Revenue Act of 1988. So in 2019, the Treasury decided it was going to issue proposed regulations to update these regulations. And they say in the announcement that they're updating it for the Technical and Miscellaneous Revenue Act of 1988, but actually they're going all the way back to the Tax Reform Act of 1986, okay? The scope of the changes to the current regulations issued under Section 301 made by these proposed regulations is limited to: 1, deleting regulatory provisions made obsolete by statutory changes; 2, making minor additions and revisions to regulatory provisions to reflect current statutory text, excellent, from 88 to 2019. And third, and my favorite, is making certain non-substantive changes for purposes of clarity and readability, including reordering and redesignating paragraphs of the current regulations. Obviously, this is a very admirable goal and one that we would all like to see happen. But as we move through the presentation, we'll see how all that worked out. In 1986, the amendments to Section 301B1 added special rules to determine the basis of property received from foreign distributing corporations and corporate distributees. Prior to the amendment, Section 301 of the Code provided generally that in the case of corporate distributions of property to a corporate distributee, the amount distributed equaled the lesser of 1, the fair market value of the property, or 2, the adjusted basis of the property in the hands of the distributee, increased in the amount of the gain recognized to the distributing corporation on the distribution. So this was a hangover for those of you who may remember from your first corporate tax class in law school, or if you went maybe to a master's program in taxation, from the General Utilities Doctrine and Eisner versus Macomber, okay? The Act provides that on a non-liquidating distribution of property to a shareholder, including to a corporate shareholder, gain but not loss is recognized to the distributing corporation as if the property had been sold to the distributee for fair market value. So there's gain both at the corporate level and there's gain at the distributee's level. The 1988 amendments to 301B1 eliminated the distinctions between corporate and non-corporate distributees and special rules relating to foreign corporations. Additionally, they enacted Section 1019 in these amendments that provide that the 1998 amendments were effective as if included in the Tax Reform Act of 1986. So 2019, we've got changes that are going to be read as if they were included in the Tax Reform Act of 1986. As a result of these amendments, Section 301B provides that for purposes of Section 301, the amount of any distribution shall be the amount of money received plus the fair market value of other property received. Furthermore, Section 301D now provides that the basis of property received in a distribution to which Section 301A applies shall be the fair market value of that property. And of course, that makes sense because there's taxable gain both at the corporate level and upon the distribution to the distributee. Let's illustrate that with the following example. Corporation M, formed in 1998, has never been an acquiring corporation in a transaction to which Section 381 applies. On January 1 of 2019, an individual owned all of the stock of Corporation M, consisting of a single share of stock with an adjusted basis and a fair market value of $2,000. During 2019, A received distributions from Corporation M totaling $30,000, consisting of $10,000 in cash and $20,000 in listed securities with a basis equal to $20,000. Corporation M's for the taxable year as of December 31, 2018, had accumulated earnings and profits in the amount of $26,000, and it had no earnings and profits and no deficit for 2019. Take a look at Section 316A1 and Section 301C1. Of the $30,000 received by A, $26,000 will be treated as an ordinary dividend under Section 301C1. The remaining $4,000, the difference between the $30,000 and the $26,000, will be applied against and reduce the adjusted basis of A's stock. Remember, his stock basis was $2,000, so now his stock basis is reduced under 301C2 by $2,000 to zero. And now we have an additional $2,000 left of that $4,000, and under 301C3A, that will be treated as gain from the sale or exchange of his stock. So if his stock was held for more than 1 year as in a capital asset, he would have a capital gain. But of course, at the end of this transaction, the basis of his stock will be zero. So if he subsequently sells, he'll have no basis to recover. The proposed regulations update Section 1.301 to reflect the statutory changes made to Section 301B1 and D by the 1988 amendments. Now, here's something interesting. Specifically, some of the provisions of current regulation Section 1.301-1B are now found in proposed regulation Section 1.301-1C. Thus, the definition of the amount of the distribution subject to Section 301 and the determination of the fair market value of the distribution remains in Section 1.301-1B, while the determination of when to include a distribution in gross income and its fair market value is now found in proposed regulation 1.301-1C. Also, current section 1.301-1G is redesignated as proposed regulation 1.301-1F and is revised to clarify the application of the principles incorporated in section 357D, added in the 88 amendments, to the limitation on the amount of the distribution provided by section 301D1. Perhaps this redesignation and the movement of permanent regulations into proposed regulations is part of the clarity and readability that the IRS decided that they were going to deliver for us under section 301. So I guess what I am suggesting to you is be prepared to look around to actually find the law, because it won't be in the logical places where you would think it was. And some final regulations have now been moved into proposed regulations, which I'm not really certain why they did that, okay? Anyways, on March 28th, 2019, the Treasury withdrew all of the 209 proposed regulations regarding the allocation and recovery of stock basis in redemptions, having determined, and I quote, "It is unlikely that the approach of the 209 proposed regulations can be implemented in a comprehensive final regulations without significant modifications." I want you to remember that, because in just a few minutes, we're going to see how they reverse themselves on that. It would appear, but it is certainly not without doubt, that the Treasury still holds that with respect to redemptions governed by section 302D, complete terminations of the shareholder's interest, which also includes the application of Code section 318 attribution rules, attributing stock of other persons, whether family, from partnerships, to partnerships, from trusts, from estates, etc., to the redeemer of those shares, okay, can be used to be transferred either to other stock that the stockholder has in the failed redemption. It was an attempted redemption. It fails under 302D and B3 because of section 318. And so now it's treated as a dividend distribution. As a dividend distribution, of course, you don't get to recover your basis. So if you take, perhaps some of your clients have family corporations where they have, for a generation, invested in the company, not taking out the earnings other than a salary, constantly putting capital into the corporation, and thus adding that to the basis of their stock. They have substantial unrecovered basis in their stock. So they try to do a redemption, okay? And they run afoul for one reason or the other, okay, because they're going to retire. But they run afoul of section 318. And of course, therefore, it's not a complete termination. So it's going to be treated as a redemption. But they have no stock shares left. What happens to their basis? This is the issue that has been around for really quite some time, known as the disappearing basis issue, okay? So originally, the Treasury Department took the position that the unrecovered basis in the redeemed stock of the shareholder, because it's now treated as a dividend, could be shifted either to other stock that shareholder happens to be holding, okay? But if it's a complete termination, of course, he's turned in all his stock, so he doesn't have any stock. So the alternative, in the Treasury's view, was that it could be also shifted to the person whose stock was attributed to him or her, okay, as a result of the application of 318. Now, there was a requirement before this could happen under regulation section 1.302-2C, which said that this shift could only occur if it were deemed to be a proper adjustment, okay, within the meaning of that very reg 1.302-2C. Well, interestingly, our prior panel would be interested in this. I'm sure they know about it. In Notice 2001-45, the IRS took the position that a basis shift from a non-U.S. taxpayer to a U.S. taxpayer, think about those consequences, a non-U.S. taxpayer, not really caring about what his basis is in the corporation, a U.S. taxpayer caring a lot about the recovery of that basis, okay, was, in quotes, not a proper adjustment within the meaning of regulation section 1.302-2C2. So then in 2009, these regulations that were just fairly recently here in 2019 withdrawn, okay, there was a proposed regulation which was even a little bit more interesting, okay? And the proposed regulation is proposed regulation, now withdrawn, section 1.302-5B4. That's why I say the shifting of basis, I think, is still available, but that's not for certain, because we have this proposed regulation that was out there since 2009, now withdrawn as a part of all the other regulations being withdrawn, so we don't know whether they're going to reissue that regulation or not. But let me just tell you what that regulation provided, because it was kind of interesting, particularly when applied to this ongoing issue of disappearing basis. The regulation said that there will be no immediate recovery of the basis. Rather, the loss will be suspended or deferred until the inclusion date. And how was the inclusion date defined? Well, the magical inclusion date is when the facts and circumstances occur that would have treated the distribution as a redemption if they had occurred at the time of the original date of the purported and attempted redemption that was treated as a dividend. So let's just think about that for a minute. What does that mean? Well, in a family context where we have one generation that established the business and a younger generation that is now going to take it over, that stock under 318A1 will always be attributed to the parents, okay? So I guess unless the two children are hit by a car and die, okay, and then of course the stock will be in their estate and still will be subject to attribution under section 318 under entity attribution, okay, we won't have reached that magical inclusion date. Anyways, yes, those regulations have been withdrawn, but that regulation was in effect since 2009, and we really don't have any assurance that this is not the position of the Treasury, because it continues to say that it shall pick and choose as to when they will allow the transfer of the unrecovered basis under section 1.302-2C. Okay, so I want to talk a little bit now about the continuity of interest requirement, because it's related to section 355. The IRS has withdrawn, now also the 2011 proposed regulations that would have provided guidance on how to determine whether certain transactions satisfy the continuity of interest requirement under regulation section 1.368-1E, which is applicable to certain corporate reorganizations, as described in section 368. Only certain ones, not Ds or Fs, but all the other ones in 368. The 2011 regulations would have permitted taxpayers to use an average of the trading prices of an issuing corporation stock over a number of days in lieu of its actual trading price on the closing date. Closing date would be the date that, pursuant to the reorganization contract, they were going to actually exchange stock and money, okay, in this reorganization. So originally the position was we take one date, the closing date, that's when we're going to measure the acquiring corporation against the target corporation to determine whether the value reaches the requirement of the continuity of interest under section 1.368-1E and whether or not that's satisfied. So specifically the regulations have proposed a method for determining whether continuity of interest is satisfied when a contract to the effect of a potential to affect a potential reorganization provides for variable consideration based on the changing value of the issuing corporation stock. So this is typically stock in a listed and established market that could be traded and so we know the value of it. And so originally they wanted you only to use the closing date in order to do that. But in these regulations, they opened the door, the Treasury Department and the IRS opened the door to saying, well, let's if we measure it over a period of time, that seems to be okay too. And so I think there was some happiness and some light at the end of the tunnel. Now, of course, I say those are the 2011 proposed regulations, which have now been withdrawn. But In the interim, they decided, we could illustrate this before we move on to this problem. Okay, great. On January 3rd of year one, P&T signed a binding contract pursuant to which T will be merged with and into P on June 1 of that year. Pursuant to the contract, the T shareholders will receive 40 P shares and $60 worth of cash in exchange for all of the outstanding stock of T, the target corporation. 20 of the P shares, however, will be placed in escrow to secure customary target representations and warranties, not unusual. The P stock is listed on an established market, and on January 2nd of year one, the value of the P stock is $1 per share. On June 1 of year one, T merges with and into P pursuant to the terms of the contract. On that date, the value of the P stock is 25 cents per share. None of the stock placed in escrow is returned to P because the contract provides for the number of shares of P and the amount of money to be exchanged for all of the proprietary interest in T under this paragraph and section 1.368-1E2. Therefore, when the transaction satisfies the continuity of interest requirement, will be determined by reference of the value of P stock on the pre-signing date to the value of the entire consideration received by T, both in stock and cash, to determine whether or not it's going to meet the continuity of interest requirement, i.e. that they have enough proprietary interest in the ongoing business to meet this requirement. In this case, in the regulation, it says that they do satisfy the requirement, and that's consistent with the IRS's position to generally treat the continuity of interest requirement as satisfied when at least 40% of the consideration received by the target corporation's shareholders in exchange for their proprietary interest in the target corporation consists of stock of the issuing corporation. You can take a look at Reg Section 1.368-1E2, Roman 5, Example 1. 1.368-E2, Roman 5, Example 1. Prior to 2011, the determination of whether the continuity of interest requirement is satisfied had been based on the value of the issuing corporation as of the effective date of the reorganization, which was the closing date. Only one date was used. The regulations, the proposed ones that have now been withdrawn, opened up the opportunity for a period of time and looking at and of course they've been withdrawn. But I guess the good news is that we have the issuance of, in January 2018, the IRS issued Rev Proc 2018-12, which provides three average pricing safe harbor valuation methods and measuring periods to assist the taxpayers in determining whether publicly traded stock received by a target corporation's shareholders in a potential reorganization will satisfy the continuity of interest requirement. If the safe harbor requirements of Rev Proc 2018-12 are satisfied, the IRS will not challenge a taxpayer's use of certain stock valuation methods to determine whether the continuity of interest requirement has been satisfied. The three safe harbors set forth in Rev Proc 2018-12 are: 1, average of the daily volume weighted average prices measured over each day of the measuring period. 2, average of the average high and low daily prices, that's the second method, again measured over each day of the measuring period. And the third, average of the daily closing prices. Now that is just on the closing date, so kind of a reversion, although they allow you to take the high and low on the closing date. So if you use any of those three safe harbors and you meet the 40% requirement, you'll be deemed to meet the continuity of interest requirement. So Rev Proc, so the takeaway here is ultimately the enactment of Rev Proc 28-12 leads Treasury and the IRS to conclude that the current pronouncements provide sufficient guidance regarding the COI requirement, and therefore they decided to withdraw the 2011 regulations. However, the revocation of the 2011 proposed regulations and the retention of the methods contained within Rev Proc 2018-12 reflect, I think, the IRS's now position that the average trading price methods may be more reliable estimate of the fair market value of the issuing corporation stock than its trading price on a single day, i.e. the effective date or closing date of the reorganization. So that gives us some hope. The IRS also announced on March 12, 2019, this is on section 355 now, we're going to leave continuity of interest and move to 355. The IRS announced on March 12, 2019, that the pilot program for private letter rulings under Rev Proc 27-52, pursuant to which the IRS was willing to issue rulings addressing the general tax consequences of Section 355 distributions, would be extended indefinitely. The pilot program was scheduled to end on the very date that they announced the extension, March 19, 2019. So now taxpayers may obtain rulings on general federal income tax consequences of these distributions and related transactions. The Section 355 rulings are no longer limited to significant issues under the pilot program, because there's different ways to get these rulings, as we'll see in a minute. The pilot program does not change, however, the no ruling position of the IRS regarding issues of whether or not the transaction is used, one, principally as a device to distribute earnings and profits of the distributing and or the controlled corporation, or whether or not there's a valid business purpose. Rev Proc 2017-52, which has been amplified and modified by Rev Proc 2018-53, includes therein the various procedures what you have to give to the IRS in order to obtain a ruling for a Section 355 disposition, spinoff. In December 2018, the IRS announced that it plans to issue a new revenue procedure integrating previous guidance on spinoffs, including Rev Proc 2018-53 and Rev Proc 2017-52. So one would have to wonder why the IRS had previously stated that they felt that there was enough authority out there to issue them, and now they're going to go back and they're going to issue apparently some more rulings. But it seems that they're heading in the right direction, so perhaps this will solidify even more the various ways and methods of getting rulings under Section 355. So maybe I just give you a little history of that, because these Section 355 transactions are important. They're spinoffs. And to qualify for tax-free transaction, you must meet specific, obviously, statutory requirements under Section 355, as well as a number of judicially developed requirements as follows. You have to show a valid corporate business purpose, okay? You have to show continuity of shareholder interest. Well, we discussed that. And you have to show continuity of at least one active trade or business that has been conducted for at least 5 years and that was not acquired in a taxable manner during those previous 5 years. So taking a look at the foregoing requirements, they're very complex and entail, for any practitioner, an in-depth analysis in application, looking both at and examining both the history and makeup of both the corporations that are going to be involved in this distribution. Moreover, even when the requirements of Section 355 appear, you look through it, you say, I think I have them met, a subsequent acquisition after the 355 transaction of either the distributing or controlled corporation may cause the disqualification or at a minimum a corporate level tax. Because of the significant and substantial differing tax treatments for qualified versus non-qualified Section 355 distributions, coupled with the fact-based nuances of each transaction, taxpayers doing Section 355 transactions have historically sought rulings from the IRS as to whether the transaction will qualify for tax-free treatment under Section 355. Because when you guess wrong, it's a disaster. So depending upon your client's tolerance for risk, you may want to get a ruling. And now you can get a ruling continuing indefinitely under this pilot program. But let's take a look at the history a little bit to see where we might be going. Prior to 2017-52, the IRS issued numerous rulings on the tax consequences of 355 distributions, including issues of whether distribution was primarily a device for the distribution of E&P, the valid corporate business purpose requirement, and Section 355E issues. So when they started out, they were willing to give general rulings on the general tax consequences, if you asked them for, under Section 355, including whether or not, in looking at the transaction, it was principally a device to distribute earnings and profits, and also all the Section 355 issues. Then in Rev Proc 2013-32, the IRS announced, I'm sorry, I have to go to Rev Proc 203-48. The IRS announced that it would no longer rule in certain aspects of Section 355 distributions, including the issue of whether the distribution was primarily a device for the distribution of E&P, nor would they rule on the valid corporate business purpose requirement, nor would they rule on Section 355 issues. Then, in 2013, in Rev Proc 2013-32, the IRS announced the requirement and even further restrictions, stating they would no longer rule on Section 355 distribution transactions except on significant issues, i.e. specific issues of law. Thereafter, in Rev Proc 2016-45, the IRS announced that significant issue rulings would be issued on the device prohibition and the corporate business purpose requirements, which were previously no rule areas under Rev Proc 203-48. So where are we today? So where we are today is we have a pilot program where you can get a general ruling for your Section 355 spinoff, but under that pilot program, you cannot get a ruling on whether or not the transaction is principally a device to distribute earnings and profits of the distributing or the controlled corporation, nor can you get a ruling on whether or not you have a valid corporate business purpose. However, if you send a second ruling in under Rev Proc 2013-32, you can get a ruling on those two issues. So I guess the IRS was wrong when they said that they had it all figured out, and they're right now when they say that we have to reissue and integrate all these rulings so that taxpayers wouldn't have to file two rulings in order to get all the determinations that they wanted from the IRS. Conclusion, my takeaway on this is ultimately the extension of the ruling pilot program will allow taxpayers to continue to request transactional rulings on the tax consequences of distributions under Sections 368 and 355. The indefinite extension is a welcome development for taxpayers as they await a possible new revenue procedure or procedures that would formally extend the full transactional program and integrate other guidance on spin-off rulings. Okay, another interesting development in the active trader business requirement is that to qualify for tax-free treatment, various requirements must be satisfied, including the requirement under Section 355B that the distributing corporation and the controlled corporation can be engaged in an active trader business. The regulations under Section 355B provide that an active trader business ordinarily must include the collection of income and the payment of expenses. Now here's something I think that's interesting. The IRS recently reported that it has observed a significant rise in entrepreneurial ventures that have activities consisting of research and development over lengthy phases. During these phases, the ventures often collect no income or negligible income, but incur significant financial expenditures and perform day-to-day operational and managerial functions that historically have evidenced an active trader business. So a spin-off for a high-tech firm, pharmaceutical firm, R&D, development in whatever area. They're saying that because even though there's no generation of income, they're receiving and they want to collect information on whether or not they would actually be able to fulfill the requirements of an active trader business without the collection of income. Because historically, without the collection of income, this has been a major problem. But now in these areas, they're asking for information. So if you can put up slide 26. Anyways, due to the emergence of these ventures, the IRS and Treasury Department are considering guidance, so they want to hear from you, to address whether a business can qualify as an active trade or business if entrepreneurial activities, as opposed to investment or other non-business activities, take place with the purpose of earning income in the future, but no income has yet been collected or it's very minimal. And the slide, you can look at that on your own. I'm not going to read that to you. That tells you the information that they would want if you have clients that might be interested in something like that. My conclusion is that this possible good news is the Treasury and the IRS study may lead to guidance permitting entrepreneurial ventures and in the absence of revenue to satisfy the active trade or business requirement. Okay? Where are we? Okay. So I think what I'm going to do, because I'm going to skip the NOLs, and I'm going to move to some individual updates for you, or we won't get any of that in. Okay, the one big one, I guess, that everybody's fairly interested in is final regulations under Section 199A. On January 18, 2019, the Treasury Department and the Internal Revenue Service issued final regulations and 3 related pieces of guidance on the new qualified business income, QBI, deduction, Section 199A. The new QBI deduction, created by the 2017 Tax Cuts and Jobs Act, allows many owners of sole proprietorships, partnerships, S corporations, trusts, or estates to deduct up to 20% of their qualified business income, known as QBI. Eligible taxpayers can also deduct up to 20% of their qualified real estate investment trust, REIT, dividend, and publicly traded partnership income. The guidance release includes a set of regulations finalizing proposed regulations issued last summer, a new set of proposed regulations providing guidance on several aspects of QBI deduction, including REIT dividends received by regulated investment companies, a revenue procedure providing guidance on determining W-2 wages for QBI deduction purposes, and a notice on the proposed revenue procedure providing a safe harbor for certain real estate enterprises that may be treated as a trade or business for purposes of the QBI deduction. That one's very close to my heart. So Regulation Section 199A-3B1 Roman 4 of the final regulations provides that previously disallowed losses or deductions, including under Sections 465, 469, 704D, and 1366D, allowed in taxable years, are generally taken into account for purposes of computing QBI, except to the extent that the losses or deductions were disallowed, suspended, limited, or carried over from taxable years ending, and this is an important date, January 1, 2018. January 1, 2018. These proposed regulations amend Regulation Section 1.199A-3B1 Roman 4 to provide that such losses are treated as losses from a separate trade or business. To the extent that losses relate to a public traded partnership, they must be treated as losses from separate public traded partnerships. That's Regulation Section 1.199A-3B1 Roman 4 large B provides that the attributes of the disallowed losses are determined in the year the losses were incurred. These proposed regulations provide rules under which a regulated investment company that receives qualified REIT, real estate investment trust, dividends may pay Section 199A dividends, and that they'll be subject to the 20% QBI deduction. Non-corporate shareholders receiving Section 199A dividends would treat them as qualified REIT dividends under Section 199A3, provided the shareholder meets the holding period requirements for its shares under the Regulated Investment Company Act. In general, when calculating W-2 wages for taxable years under methods described in this revenue procedure, that's Rev Proc 2019-11, include only wages properly reported on Forms W-2 that meet the applicable rules of Section 1.199A-2B. Under Notice 2019-07, under this proposed safe harbor, a rental real estate enterprise may be treated as a trade or business for purposes of Section 199A if at least 250 hours of service are performed each taxable year with respect to the enterprise. So this is a 212 activity that, because 199A describes these as trades or businesses, but this is an important provision for someone who might have a number of rental properties, okay? But there's requirements in order to get this. It includes services performed by the owners, employees, and independent contractors, and the time spent on maintenance, repairs, collection of rent, payment of expenses, service to tenants, and efforts to rent the property. So that 250 hours includes those elements. It also requires that the taxpayer must maintain separate books and records to reflect income and expenses for each real estate enterprise. So if you have, let's say, you're renting you have 3 duplexes, separate records for each one, okay, with regard to the 250 hours, okay? The taxpayer must maintain contemporaneous records, including time reports, logs, or similar documents regarding the following: hours of all services performed, description of all services performed, dates on which all services were performed, and who performed the services, because you can use independent contractors or employees. These records are to be made available for inspection at the request of the Internal Revenue Service. This requirement will not apply to taxable years beginning prior to January 1, 2019. So it commenced this year. Another area of interest perhaps in the final regulations. 5? 6, okay. With regard to charitable contributions to state and local tax credits. On June 11, 2019, the U.S. Department of Treasury and the Internal Revenue Service issued final regulations that require taxpayers to reduce their charitable deductions by an amount of any state or local tax credits they receive or expect to receive in return. The final regulations apply. This is an application of the tax benefit rule. The final regulations apply to contributions made after August 27, 2018 and are effective on August 12, 2019. Taxpayers may treat payments they make in exchange for these credits as state or local payments, which allows some taxpayers to deduct certain of the payments and taxes. Treasury Decision 9864 finalizes proposed regulations published on August 27, 2018, that were designed to clarify the relationship between the state and local credits and the federal tax rules for charitable contribution deductions. Under these final regulations, a taxpayer making payments to an entity eligible to receive tax-deductible contributions must reduce the federal charitable contribution deduction by the amount of any state or local credit that the taxpayer receives or expects to receive in return. So this is an application not within the federal government. Many of us, I think a lot of you have looked at the tax benefit rule. When you get a tax benefit, you have to recapture it at some point in time. This is an application of that tax benefit rule between sovereigns, from the federal down to the state, okay? So a tax benefit, as a result of a deduction that you got at the state level that provides you with some credits, is going to have to be recaptured at the federal level. There's some examples, but as I'm running out of time, I'm going to skip through those examples. Let me just say now that the materials of all the presenters today, okay, are going to be available online. So all the participants in this symposium, in about 3 weeks, I think it'll take 3 weeks, it might take a few days longer, will receive an email with a link that will allow you to access not only the video presentations, okay, but also, perhaps more importantly, for those of you who want to do a deep dive, the outlines and the materials provided by the speakers. So don't be so concerned that I can't cover every single thing, because I have to save time for my colleagues. So I just want to mention to you that Revenue Ruling 2019-11 deals with SALT refunds, It's basically the same type of approach, okay? It takes a tax benefit analysis, okay, between state tax consequences and federal tax consequences and makes you recover them at the federal level. While I don't know this for certain because the H.R. 1, Tax Cuts Jobs Act, I could use the acronym, but I can't pronounce it, had to find a way to try to pay for some. As you know, the way the act was passed, which is a discussion far beyond the purview of my discussion here today, but it would be a lively one. The way in which that act got passed avoided the Deficit Reduction Act, okay? Meaning that historically, when you give a tax deduction or a tax benefit, you got to find a way to pay for it, okay? Well, that went out the window in the manner in which this act was passed. And that was primarily a function of the fact that the act was passed without any bipartisan support. And on all bills, tax bills that end up that way are usually bad. But that seems to be the environment we're into, and as I said, that's far beyond the purview of this talk. But anyways, you want to take a look at Revenue Ruling 2019-11 with regard to your SALT refunds. It does provide an opportunity to get some deductions with regard to real property taxes or state taxes that you paid. But remember, there's a $10,000 limitation under 164D. So don't get too excited. Take a look at it, but don't get too excited because of the Section 164D limitation. 10,000, 5,000 if you're married, 5,000 if you're married, filing separately. I'm going to leave estate and gift tax updates for the next panel, but I would like to mention to you that obviously under the TCJA, the personal exemption, which was indexed for inflation, started at $5 million, was 5.49 million for individuals, is now in 2019 11.4 million per taxpayer, or 22.8 for two taxpayers. Okay, and the 2503B annual exclusion amount, that's per year per donee for 2019 is $15,000. But you're going to hear a lot more of that in the next panel. Thank you very much. So I'm going to introduce our next speaker, okay? And I have to tell you that Jason was very recently my law student. In fact, he graduated in 2017, got his LLM in tax in 2018 from the University of Florida, immediately went to work for one of my other former students who graduated earlier and went and got his LLM at New York University. Went to work for him, but yesterday afternoon I got a phone call from David Bauer, and David hired Jason in 2018 when he came out of the UF program, and he said, I'm feeling bad again like I did last year in my stomach. And I said, well, you better take care of that. I told you had to start exercising, so on and so forth. Anyways, have it be known that he goes into the hospital to see what's going on, and he's having his appendix removed this morning. I assume it's completed. I don't know. So Jason is pitch hitting for David. And so we have to be very, very nice to Jason. Thank you very much, Jason.
So as Professor Wolf said, I am pitch hitting this morning. I will not be able to do as in-depth analysis as David had planned. I don't have his materials, so I'm, for all intents and purposes, using my own that I gathered together. But I can promise that we will cover some interesting material and we will have some fun. So let's get to it. We are going to be talking about qualified opportunity zones. Qualified opportunity zones were added in the Tax Cut and Jobs Act under Subtitle A, and they added Subchapter Z. If you look at there's only two statutes, 1400Z-1 and 1400Z-2. These two statutes allow individuals and corporate taxpayers to defer capital gains on the sale of stock, business assets, and other property by investing these proceeds into opportunity funds, which in turn must invest at least 90% of their assets, directly or indirectly, into businesses located in certain locations called qualified opportunity zones. Now, these opportunity zones are low-income areas that were designated by the 2010 census. Each state, on or before March 21st of last year, 2018, or if they asked for an extension, the governors had to designate certain tract areas that they qualified as low income, okay, and had to send those to the Treasury for approval. Governor Scott did that. We have our track set, and those are the zones that you have to, those are the zones you have to invest in to reap these benefits. Now, although certain zones had to be low income per the census tract, it did give discretion to the governors to designate certain zones that they wanted investments in as well. So when you look at the qualified opportunity zone map, I think the best one is on cdfi.org. You can find the best one on there. You're going to recognize that there's certain places that you wouldn't first think that, you know, this is low income, and that's probably for certain lobbying reasons. But moving on from that. So, when an individual recognizes capital gains, they can defer these capital gains. They have until 180 days after they recognize these capital gains to defer them by investing them into a qualified opportunity fund. A qualified opportunity fund is defined as a corporation or partnership that invests 90% of its assets into qualified opportunity zone businesses or property. And these entities are set up as either corporations or partnerships. Sorry, flipping through the notes. So, a qualified opportunity is an investment vehicle set up as a corporation or partnership. Eligible investors into these are individuals, corporations, REITs, partnerships, S corps, trusts, and estates. As I mentioned, 90% of their assets must meet this test to gain the benefits. To become a fund, if you look at the statute, there is no guidance on there, and they're allowing the new market tax credits. They allow a self-certification process. What this involves when you go through the regulations is with a tax return for each year for the taxpayer and for the Qualified Opportunity Fund, you're going to be filing a Form 8996, which shows the calculations for the fund to show that you meet this 90% test. Now, the real benefit to these funds are twofold. One, it allows a deferral of capital gains, and it also leads to a reduction of the capital gains the taxpayer would have otherwise paid, and it can potentially lead to an overall forgiveness of all the appreciation gain in the Qualified Opportunity Fund. So let's use some numbers. An individual invests $100 of deferred capital gains inside of a Qualified Opportunity Fund. If he holds that investment inside the fund for less than 5 years, he really gains no benefit besides the deferral of paying those capital gains that he would have otherwise paid. If he holds the investment inside the fund for at least 5 years, 10% of the capital gains that he would have otherwise paid are now forgiven. If he holds them in the fund for more than 5 years, and he holds them more than 7 years, he gets an additional 5%. So now 50% of the capital gains that he would have otherwise paid are now forgiven. And which is not possible right now because the statute technically has a drop dead date of December 31st, 2026. If you have the investment inside the fund, the initial capital gains past December 31st, 2026, you can wipe out the entire deferral of the initial capital gains that you invested. Now, although you can't wipe away the initial investment capital gains, you can, if you hold the investment inside the fund for more than 10 years, all the appreciation gain that you recognize on your investment in the fund will be forgiven. Let me find the exact language for you. Sorry. So for the opportunity fund investments held more than 10 years, the tax basis for your interest in that fund will be deemed to be the fair market value on your date of sale. Now, with these two statutes, there have been two sets of proposed regulations. The one that was released on October of 2018 has now been finalized. The one that has been released for April of 2019 is still under review and still taking comments. Inside the fund, what we see most people doing is they're operating qualified opportunity zone businesses, which are subsidiary businesses that are owned by the funds, which have to meet certain requirements. Substantially all of the tangible assets have to be owned by the fund. At least 50% of the gross income has to be earned by a business that's having active conduct inside the fund, inside the zone, and it precludes certain types of operations. But that's one of the things that we have been seeing a lot, that people are trying to operate businesses inside these qualified opportunity funds to gain additional benefits. Sorry. So, with the Qualified Opportunity Fund, like I mentioned, you can have qualified opportunity businesses inside there. You can also own qualified opportunity property, which is just property that's inside the fund. When you own property inside the fund, the regulations state that you have to improve the property, to substantially improve the property. This has been defined in the second set of regulations as doubling the basis. So if you buy a piece of property for $100,000, you have to double the basis to $200,000 within the first 31 months of having that property inside the fund. Sorry, kind of rambling at this point. So you have to double the base of there. If you're just acquiring bare land or a piece of property that has been vacant for more than 5 years, you can be deemed as original use, and you technically don't have to improve or invest more into the basis of your initial investment of purchasing that property inside the fund. Additionally to that, these funds offer benefits to hold stockpiles of cash which are deemed net working capital. Inside the Qualified Opportunity Fund itself, you can hold cash for up to 31 months as long as you furnish a plan showing how it's going to be used to the IRS, and you can show that it will be used at certain deadlines to help benefit the fund's projects. These rules change under qualified opportunity businesses, which qualified opportunity businesses don't have the same 90-10% test that the fund has. They have a lower requirement of you have to have 70% of your operations or of your assets inside the zone. So you can have an additional 30% outside of the qualified opportunity zone. Do you think it would be beneficial if I open the floor to questions to help clarify some of this?
Sure.
I know I'm kind of throwing all this at you. So I would like to open the floor to questions to kind of, help parse some of this out. No question? Okay.
If you already have an existing business that just happens to be in this, so the main reason to do this would be if you were going to go through some major expansion, right?
Well, not necessarily a major expansion. If you have already existing, the second set of regs have touched on this, and they're not allowing right now, if you have property inside the fund, to kind of take on these benefits. The purpose behind the fund being is they want new money to come in. You already having a business or a property inside the zone, they have no reason to compel you to put your money there. It's already there. Yes?
Part of the confusion is that there are two gains to talk about. One is the gain on your first investment, your stock that you made money on.
Yes.
And then the second is a potential gain on your investment in the qualified opportunity zone. And is it not true that on the deferral of the gain, the original gain sale of the stock, that there is no permanent exclusion, that it's only a deferral?
That's correct. Because
Isn't it probable that you're investing money and it's in your qualified investment opportunity zone, and then you have to come up with cash to pay the tax on the deferred gain?
Well, that has been mentioned by many commentators that you have to pay at the end of 10 years, you have to pay that 85% tax if you kept in the fund for over 7 years on that 85% phantom gain that, that's invested in the fund right now. But if you have that cash available and you keep your investment in the fund for over than 10 years, then you can hopefully gain full forgiveness of all the appreciation on your investment inside the fund. Also, we know it's on the new investment.
But you still have to pay tax on the old.
Correct.
Deferred is never forgiven.
Correct.
Let me just add something to that, because, okay, so here's what I think, just to look at it economically. Let's say you have a $100,000 capital gain, and you decide to invest that capital gain, which would be, you're in the maximum tax bracket 23.8, okay? Maximum capital gains tax bracket. So you'd have to pay that on April 15th of year 2. You sold in year 1. You don't have to pay that. If you stay in the fund for 10 years, you effectuate a 10-year deferral on the payment of 23.8% of $100,000. So if you took the 23.8% and put it in any type of investment, you're going to have a return on that investment, all right? Then the second, I think, aspect of it is that if you leave your investment in the fund, and the fund is a good real estate investment, and it makes money, and you leave it in there for 10 years, the profit, when you sell it after 10 years and 1 day, is equal to 0, because its basis is deemed to be equal to the fair market value. So there's two things that are happening. One is the deferral on the payment of the tax, the capital gains tax that you realized today, and the second is the complete elimination of tax on the profit if you hold it for 10 years on the investment in the fund. So you want to be sure you got a decent real estate investment, I guess is what I'm saying, if you want to work both.
Two things, just to be a devil's advocate. Right? Isn't there a rule about the deferral doesn't go the full 10 years, that there's a, like you mentioned?
The December 31st, 2026.
Unless it's extended. That's right.
Yeah.
Right now, under current law, how many years is it?
On the current law, the end date is December 31st, 2026, of when you can have the deferral to appreciate.
You have to come up with a tax where your money is invested in a low income area. You're always hoping for a capital gain, but you're generally you're in a risky investment. You're in a low income area.
Yeah, I mean, like I said, and then I'll let him talk. I agree with you. That's right, because without the extender, it wouldn't be 100% forgiven. It would only be 50% forgiven. You still get the deferral. You're still going to work the deferral for the until the end of 2026 on your capital gains that you incurred. Of course, it's already 2019. This started in 2018. So you're already basically 2 years in. Okay. But that's why I said that you really want to try to get into a fund that has a good real estate investment, even if it is in, obviously, an opportunity zone. If you look at these maps, I would encourage you to look at the map, because Governor Scott picked some pretty nice properties, pretty properties that are surrounded by some pretty nice areas. For example, in Marathon, in the Florida Keys, there's areas there that are in the opportunity zone. So that's some pretty nice real estate if you're not risk adverse to hurricanes.
We get him down here and up to here.
Yeah, I just wanted to say, because I'm in the real estate practice side, to address this gentleman's question, I mean, you do have a 15% forgiveness on that gain if you hold it more than 7 years, as he stated. You get that 15% reduction. But think of it this way. If you have an asset that costs you 100 and you sell it for 200, what you're deferring the gain is on 100, but you still have cash to save if you're concerned about paying the tax by 2026, because it's your basis that you don't have to put in. You're putting in the gain into the qualified opportunity fund. And at December 31st of 2026, you're paying tax on 85% of the gain. So you have permanent forgiveness on the 15%. The idea is for you to hold this investment beyond 2026, and if you do it hold it for more than 10 years, then hopefully you invested in something that appreciates in value. I mean, what we see a lot is low-income housing or qualified housing for a workforce housing is what we're thinking about down here. That's where the interest lies on deploying this benefit, because we have a shortage of, low-income housing or affordable housing. Maybe that's a better word for it. So in the real estate space, this is being closely looked at, but some questions have been answered in this guidance, but there's still a lot of, unanswered questions. But the key is you're getting a 15% forgiveness on your gain, and you still have your basis. You invest your basis in whatever else you want to invest, but that's your cash to pay the 23.8% tax on 85% of the 100,000. You can correct me if I'm wrong, but that's my understanding, that you have the 15% exemption, basically,
No, generally.
if you hold it.
In the broad strokes, you are correct. You do have to come up with that cash in 2026 to pay the 85% tax on your deferred capital gains. But you will have that benefit of, the forgiveness of all the appreciation gained from the second investment. I'm going to get him, then we'll come down to you too.
Yes, regarding investing in a qualified fund, how are they being promoted? Private placements, friends and family?
So they can be as large or as small as you want. We've set them up so far through our firm for just one individual who wants to invest his personal capital gains inside of an area and have basically a single member LLC elect to be treated as a partnership and have his own fund for himself. And we've had, if you look at Jared Kushner, he's created almost a mutual fund that is only investing in qualified opportunity zones. So you can basically give him your money and he'll invest it for you. You're welcome.
Yeah, well, John, if you're asking the securities question, because I was going to have a panelist that was a specialist in securities law. But basically what they're doing is these would be accredited investors only. So therefore, you're not subject to the advertising requirements. You're not subject to, any limit as to how much you can raise. Exactly, yeah.
I don't know a lot about this rule, so forgive me, this is a silly question. What if you're in an opportunity zone and you got a developer build a building, and then they lease that building to a business, and the business is being run in that opportunity zone? Can you have two separate funds, totally separate investors on the same piece of property?
Yeah, you can have a qualified opportunity business, and you can have the qualified, that almost owned by the qualified opportunity fund.
So just because the lease doesn't kill it?
No,
I've learned enough to be devastatingly dangerous on this topic, but two things come to mind. 1031 exchanges and the impact. If you're in an opportunity zone and you have a piece of real estate, whether it's corporately held or whatever, what are the consequences of 1031ing your way out of the opportunity zone, should the opportunity arise, no pun intended? And secondly, if you own this in a corporate or a partnership form, distributions out of the corporate form. Because a lot of people talk about this and they talk about cash flow, because to lawyers, cash flow, but business people think cash flow, cash flow, cash flow. How do those, they're two separate topics, but can you talk about those a little bit?
so the cash that's flowing in through the qualified opportunity fund, let's just say it's rental income, okay? It'll be distributed out each year through K1, ordinary income to you and me. As far as you said the 1031 is concerned, you said 1031 out of a QRZ?
So I own property in Marathon, and 6.5 years in, I've developed it. It's a tiki bar, and somebody comes along, and I have the opportunity to 1031 it with another piece of real estate, but it happens to be in Boca Raton, not an opportunity zone.
Okay, so when you remove your funds from, when you move those monies from the qualified opportunity fund, so you 1031 that property out, that would be the transaction outward. 6.5 years under your example, you already have your 10% step up, and then you'll pay tax on your 90% of your deferred gain, and then you can just invest in there.
But my basis for 1031 purposes would be fair market value basis, if I held it for long.
If you held it
Held
long
it for long
enough.
enough.
Yeah. Okay, well, I think we can talk to Jason more afterwards, but because we've run overtime, we have one more panelist, and I want to be sure we give him up. So thank you very much,
I
Jason.
do want to say that Mr. Bauer, when he gets out of the hospital, has promised slides, so those will be available to you, and you can contact our firm for, clarification, updates, and,
Slides and outline. Our next speaker is Jacob Even. Jacob is a member of the Florida Bar, Illinois Bar, Texas Bar, United States Tax Court. He was a partner at a national law firm concentrating on defending clients in civil lawsuits. He has also represented clients in disputes with the IRS and with disputes in probate court in various business transactions and ventures in other tax matters, including corporate transactions, acquisitions, state income taxation, federal taxation of executive compensation, and federal estate and gift taxation. Prior to working in a law firm, he worked for one of the Big Four accounting firms on matters involving federal taxation of international outbound transactions. Jacob Even is a tax fellow here at St. Thomas Law School with 10 years of corporate, business, and civil litigation experience. He is a professor here at St. Thomas and directs our low-income taxpayer clinic. Well, it's not really an LITC, it's just a tax clinic. When I founded it was an LITC. Now it's a straight tax clinic. Jacob Even.
Thank you. All right, well, while I'm sure everyone in here today is experts in ethics, nevertheless, I'm going to talk about ethics because I want you all to be able to get CLE credit. And I'm also going to be talking about technology and all these issues as they relate to tax law.
Is that the webpage?
So getting into this first, we're first going to talk about Circular 230, go through a brief history, the intended purposes behind it, some recent case law or somewhat recent case law that affects the scope of it, the current state of it. Then we're going to move on into technology, and we're going to talk about the IRS's Integrated Modernization Business Plan. So first, Circular 230. What is it? It's rules governing the practice before the Internal Revenue Service. It's presently sectioned into 5 subparts. Subpart A addresses rules relating to the authority to practice before the IRS. Subpart B contains duties and restrictions relating to the practice. Subpart C contains sanctions. Subpart D addresses disciplinary hearings. Subpart E addresses access to official records. The Office of Professional Responsibility is part of the Department of Justice, and they're responsible for enforcing Circular 230 and issuing disciplinary action pursuant to it. Circular 230 is codified as Section 31 USC Section 330. It was first published as part of the Horse Act of 1884, and it was done to give the Treasury the authority to regulate agents representing people before them. It's evolved, obviously, over time. And it's important to keep in mind that you don't have to be an attorney or a CPA to be in the business of preparing taxes. Up until the year 2011, anyone in the United States could engage in the business of preparing tax returns for profit. The rules were changed with Circular 230 in 2011 when it imposed certain requirements on individuals engaging in the business of preparing tax returns, and again in 2014 when Circular 230 imposed certain requirements on individuals issuing written tax advice. As attorneys, we're regulated by professional rules. Rules regulating state bar, and if you're practicing in state court, you may be regulated by the ABA model rules of professional conduct. Same with accountants. They're regulated by the American Institute of Certified Public Accountants. But what about tax preparers who are not attorneys or CPAs? Who's regulating them, and should we care about this? Just to give you some numbers to kind of put some of this in perspective. In 2016, there were approximately 734,000 preparer tax identification number holders. Of this, approximately 430,000, almost 60%, were not attorneys or CPAs. In 2017, there were approximately 727,000 P10 holders. Of this, approximately 483,000, over 66%, were not attorneys or CPAs. Circular 230 requires anyone who prepares a tax return for compensation to obtain a P10. Prior to the decisions in the cases that we're about to discuss, Circular 230 prohibited anyone who is not a practitioner from preparing or assisting in the preparation of a tax return or signing or submitting a tax return or a claim for a refund. So Circular 230, it was created to regulate practitioners practicing before the IRS and the giving of written tax advice. Here are some notable definitions. The practice before the Internal Revenue Service, it's really broad. As you can see, it includes preparing tax returns, making refund claims, and giving written tax advice. And below this is the definition of what a practitioner is. It covers attorneys, CPAs, enrolled agents, enrolled actuaries, enrolled retirement plan agents, registered tax return preparers, government officers, and employees. An enrolled agent, it's simply a tax professional with authorization from the federal government to represent taxpayers before the IRS. They have unlimited practice rights, so they can advise and represent individuals, corporations, trusts. They can file tax returns. They can give advice relating to tax issues, and they can represent people before the IRS. Registered tax preparers, they also have a definition of these, and their practice is limited to preparing and submitting tax returns and claims for refunds. They can only represent taxpayers before the IRS if they actually prepared the tax return. They can't represent taxpayers outside of that context. They can't issue or give written tax advice unless it is necessary for preparing the tax return, which is kind of broad ground. To become an enrolled agent, an enrolled retirement plan agent or registered tax preparer, it's not nearly as onerous as becoming an attorney or an accountant. You must be over 18. You must be able to complete an application. You have to pay a fee. You have to pass a background check. So you cannot have engaged in conduct that would allow you to be suspended from practicing before the IRS pursuant to Circular 230. So this means no felonies, no crimes of dishonesty. You have to pass a written exam administered by the IRS. You have to obtain a P-10, stay compliant with continuing education requirements. I think this is approximately 72 hours over 3 years. And you have to stay registered. Doesn't sound as bad as becoming an attorney or accountant. So there's duties and restrictions in Circular 230. And some of these are really good. There's a bunch of them listed up here. This is just some of them. There's rules relating to conflicts of interest. These are very similar to the rules that apply to attorneys and the rules regulating the Florida bar. You cannot charge unconscionable fees pursuant to Circular 230. So this includes contingent fees for preparing tax returns. So tax preparers pursuant to Circular 230, they're not allowed to charge a contingent fee for preparing a tax return or submitting a refund claim. This seems pretty good, right? I mean, it takes away an incentive for tax preparers to try to maximize a refund because it takes away their incentive for getting paid. Their payment's no longer based on the amount of money that they can collect from taxpayers. Seems like a good idea, or collect from the government on behalf of taxpayers. It also prohibits practitioners from endorsing or otherwise negotiating a check for a tax refund issued to a client by the government into an account that they control or to their personal account. Also seemingly a pretty good thing. It also contains tax preparation and document submission standards. I'm going to kind of paraphrase this, but a practitioner cannot willfully, recklessly, or through gross incompetence file a return, take a position, or advise a client to take a position or file a return that lacks a reasonable basis, that understates tax liability, or disregards rules or regulations without a good faith basis for doing so. A practitioner cannot advise clients to take frivolous positions basically on anything that's submitted to the IRS. Practitioners cannot advise a client to submit a document, affidavit, or other paper to the IRS with the purpose to delay. They can't submit documents that's missing information with the intent to evade taxes. All this seems like a great idea, and as attorneys and accountants, these are ethical duties that apply to us through the professional rules. It requires practitioners to be competent. That's a great thing too. Competence practice requires the appropriate level of knowledge, skill, thoroughness, and preparation necessary for the matter that the practitioner is being engaged for. Contains requirements for giving written tax advice, also another thing, a good thing. You know, it keeps people from recklessly issuing opinions that has potential for taxpayers to use to evade taxes, which is what the IRS wants to avoid. So practitioners can only give written tax advice if it's based on reasonable factual and legal assumptions, if the practitioner reasonably considers all relevant facts and circumstances, the practitioner uses reasonable efforts to identify and ascertain the facts, if he does not unreasonably rely on statements, the tax practitioner must relate applicable law and authorities to the facts, and the tax practitioner cannot base advice on the audit lottery. So the tax practitioner must take a position that the return is going to be audited and the positions that you take in it are going to be upheld, or that you have a basis for taking those positions. all seems like great rules and things that we want tax preparers to abide by. So the Treasury has sanctioning power for violations. So if you violate these rules, the Office of Professional Responsibility can censor you, suspend you, disbar you, and they can impose a monetary fine. So there's some case law that has come out, and arguably it's removed the bite from Circular 230, and it's all bark now. So some of these, some more notable ones, would include Loving versus the IRS. And in this case, the court found that tax return preparation is not the practice before the IRS, and it can't be regulated by the Office of Professional Responsibility or Circular 230. And the court found that the IRS cannot regulate tax return preparers because tax return preparation is not the practice before the IRS. Tax return preparers are not representatives because they do not possess legal authority to act on a taxpayer's behalf, and because they cannot legally bind a taxpayer. They also found that preparing a tax return or making a claim for a refund is not the practice before the IRS or the Treasury, as they take place before any type of adversarial proceeding or assessment begins. I somewhat disagree with this because I think the tax return is where all adversarial issues begin. But that's just my opinion on it. The case also strongly suggested that the IRS might not be able to regulate the behavior of attorneys and accountants when they are not actually involved in the administrative proceeding. So this case seriously calls into question the effect of Circular 230. Ridgely versus Liu, who was the Secretary of Treasury at the time of this case, it invalidated the Circular 230 regulations prohibiting CPAs from charging contingent fees for preparing tax returns and claims for refunds. In 2007, the IRS, through Circular 230, started to prohibit tax practitioners from charging contingent fees, like we just discussed a minute ago. Ridgely really seems to limit or alter the intended effect of Circular 230. The IRS initiated this rule in 2007 because they wanted to prevent the exploitation of the audit selection process. So it seems this Ridgely case really just undermines this and allows tax return preparers to charge contingency fees for preparing refunds or submitting claims for preparing tax returns or submitting claims for refunds. Again, it creates a personal incentive for them to get as much as possible because their fee is based on this. I don't agree with this. I think it causes a lot of issues. And in our tax clinic, we see a lot of things on these tax returns that just do not make sense. And you talk to the taxpayers, the clients, and they have no idea what it's on, why it's there, or what it's for. And our only conclusion is that the tax preparer was trying to do them a benefit, get them some money back that they're not necessarily entitled to. The Ridgely Court, they determined that Circular 230 is not applicable because they looked at the penalty provisions within the tax code, and they determined that there was another regulatory scheme available, so they disregarded the arguments that Circular 230 was intended to regulate taxpayers. For some reason, they concluded that the two are mutually exclusive and you can't have both. And there are various sections in the tax code and other laws that provide penalty provisions. For example, Section 6662 imposes a 20% penalty for accuracy-related issues on tax returns, penalizes certain misconduct. Section 6663 is a civil fraud penalty, a 75% penalty on understatements attributable to fraud. Section 6676 imposes a 20% penalty on frivolous refund claims. Section 6694 is tax return preparer penalties. Section 6701 imposes a $1,000 penalty for aiding and abetting an individual in understating tax liability. Then we get into some of the criminal sections. Section 7206 is a felony conviction and a fine of up to $100,000, $500,000 if you're if it's a corporation, and imprisonment up to 3 years for fraud or false statements, filing false tax returns. Section 7207 is another criminal statute, and any person who willfully delivers or discloses to the Secretary any list, return, account, or statement known to be fraudulent or false shall be fined not more than $10,000, $50,000 if you're assisting a corporation, and be in prison not more than for 1 year. However, the misconduct warranting one of these aforementioned penalties, it must be discovered in an audit. Based on the most recent figures, the likelihood of being audited is low. It's about as likely as the Dolphins of winning the Super Bowl this year, unfortunately. If a taxpayer earns less than $200,000 and is not claiming an earned income tax credit, is not attaching a Schedule C or a Schedule E, does not make math errors, and gets their filing status right, there's approximately a 0.6% chance of being audited. If you attach a Schedule C or a Schedule E, this only increases to 1.2%. That's better than the Dolphins have a chance of winning the World Series, actually, or the World Series Super Bowl, excuse me. So if a taxpayer earns less than $1 million and is not claiming the earned income tax credit, does not make math errors, gets their filing status correct, they only have a chance of being audited of 1.2 to 3.2%. It's pretty low. I love this quote. According to Forbes magazine, if you earn less than $200,000 annually and you don't attach Schedule C or Schedule E to your tax return, statistically speaking, you have a better chance of being abducted by aliens or dating Taylor Swift than being audited. So moving on to Sexton, and again, I tend to disagree with the Wrigley Court, and the Sexton Court kind of based their decision on the Wrigley Court too, but in Sexton, Hawkins was the director of the OPR. And in this case, the court found that the OPR's regulatory authority, Circular 230, does not extend to tax professionals offering tax return preparation services who are not authorized to practice before the IRS because he or she has been suspended for prior misconduct. It also found that Circular 230 does not apply to tax professionals providing written tax advice in connection with tax return preparation services. Here, Sexton was a lawyer who was disbarred by the state of South Carolina. He was suspended from practice by the IRS, and he had pled guilty to 4 counts of mail fraud and 1 count of money laundering. Yet even after all of this, he was out there preparing tax returns for compensation. He sent an email to a client, and he offered to provide written tax advice describing the manner in which she should file her tax return. The client did some research, found out that Sexton had been disbarred, suspended from practice, and she filed a complaint with the OPR. Sexton wanted to get in front of this, so he filed an action for declaratory judgment. That's how this court came around. And the court, surprisingly, or I guess maybe perhaps not surprisingly, they looked at the Wrigley Court, and they found that because of this other regulatory scheme, all these civil penalties, they found that Circular 230 wasn't intended to be the regulatory rules for people practicing before the IRS, and they said that the OPR didn't apply, or could not regulate Sexton, and that Circular 230 didn't apply to him. So, preparing tax returns and making claims for refunds are no longer practicing before the IRS. Tax practitioners preparing tax returns and making refund claims are not subject to Circular 230. If a tax practitioner is not an attorney or a CPA, in light of the aforementioned case law, is he or she subject to any ethical duties or regulations concerning tax preparation or the filing of refund claims? While there are civil and criminal penalties that may dissuade attorneys from filing frivolous claims or filing frivolous motions or pleadings in civil court, I'm not aware of any arguments that the rules regulating the Florida bar are redundant or unnecessary or should otherwise be revoked. Given the number of non-attorneys and CPAs that are preparing tax returns for compensation, I think it'd be a good idea if Congress would step in and clarify Circular 230 or issue some new rulings that require tax return preparers who are not attorneys or accountants, or any tax return preparer for that matter, to be subject to these ethical rules that are contained in Circular 230. I think they're a good idea. I don't think that they cause confusion. And just seeing what we see in our tax clinic, I think it'd be a good thing to hold tax preparers accountable for more so than what they are now. I mean, now it seems like it's just a negligence action, and I don't understand why there aren't more duties and rules that would apply to this, given the number of people that are out there, the number of returns that are filed, and the money that the IRS pays on in investigating earned income tax claims and various other credits and refunds that people are seeking. Given the low likelihood of being audited, it's leaves me shaking my head. So let's go on to technology now. I mean, long story short, I think Congress needs to revisit this issue, and they need to clarify Circular 230 and how it applies. So, moving on to technology, and we're going to talk about the IRS's Integrated Modernization Business Plan here. As we all know, the IRS is an extremely small agency, and they're tasked with enforcing the tax code across approximately 250 million Americans. They're also charged with protecting their accounts and their financial information. With a shrinking budget and roster, the IRS has no choice but to look towards innovative technologies in order to accomplish these goals or tasks. It's simply too expensive to continuously add systems to the IRS's current IT system, which is outdated. And this causes compatibility issues between the new technology and old technology, creates cybersecurity vulnerabilities, and like I said, it's just simply too expensive for them to keep going at this rate. The IRS is trying, like the private sector, to utilize technology to improve services and to make it more efficient. According to the IRS, taxpayers expect to access their sensitive financial information securely and easily. They want to be able to find and understand complex tax information from any device and to resolve issues quickly, proactively, and using a variety of self- and assisted services. These seem like lofty goals given the complexity of the tax code, but I'm all about the IRS improving their service. I'm not sure if any of you had to recently call, but if you can get through in faster than an hour, let me know what you're doing, because I'd take some tips on that. So the IRS has this Integrated Modernization Business Plan. It's a 6-year plan that actually started in 2019. The estimated cost for this plan is $2.3 to $2.7 billion. It includes dozens of initiatives to improve how the agency interacts with taxpayers and the tax community while continuing to strengthen cybersecurity protections in IT systems. The plan will enhance taxpayer service and enforcement activities over the next 6 years and thereafter. The plan is dependent on future funding, and it's going to it's going to be flexible for legislation changes and business changes. The IRS is actually going to monitor the performance of this plan by tracking performance-oriented measures. So some of the things that they're going to keep track of is the number of taxpayers using new services, lines of legacy code converted to modern language, taxpayer burden hours, and the National Institute of Standards and Technology cybersecurity benchmarks. According to this plan, by 2024, 75% of taxpayer interactions with the IRS will have a digital alternative, and 80% of all outbound notifications from the IRS will be sent digitally. So there's a bunch of goals of this modernization and business plan. They want to empower and enable taxpayers to meet their obligations. They want to encourage compliance through administering and enforcing the tax code. They want to provide more easy access to data, and they want to be able to integrate the data that they have so they can help prevent fraud and ensure compliance with the tax code and to minimize the gross tax gap, which was estimated at $458 billion for 2017. They also want to be able to stabilize their IT costs over time. The plan calls for delivering new capabilities each year for the next 6 years. That's going to provide better service and make information more easily accessible while still protecting and maintaining data security. So some of the things that they want to do is they want to be able to standardize customer workflows and expand access to information. They want to be able to reduce call waiting time and case resolution times with customer callback technology, online notices, and live customer support. They want to be able to expedite the return and refund processing time. They want you to be able to get real-time updates as these returns and refund claims are being processed. They also want to be able to simplify the identity verification process to expand services to everyone. Frequently, we have taxpayers that come into our clinic, and there's various ways to try to get transcripts online now, and one of the ways is it requires an identity verification feature. And if they don't have an email account, or if their credit history is shaky, or if they don't have credit cards, sometimes some of our low-income taxpayers don't. They're not able to verify their identity, and they're not able to utilize these online services. So it's a difficult task for the IRS, making information available while still protecting the data security of it. Very hot topics now. So the IRS identified 4 modernization pillars that reflect the scope of the agency's mission. And these phases are available on the IRS's website. So the first one is taxpayer experience. And this is where they're expanding their digital services and they're improving traditional channels. One of the things they did here was they recently redesigned their website to make it more tablet and phone friendly. So when you went to the IRS's website, there's compatibility issues if you were trying to look at it at your mobile device. Now when you go, there should be none, or at the very least less compatibility issues. You have more access to all the IRS's website through your mobile devices. So here the plan is to introduce new web-based applications, digital communications, customer callback, online notifications, the redesign of the website. All this is to empower taxpayers with information about their accounts, obligations, and payment options. It's also so that the IRS can integrate their systems and data. Right now, the IRS has all this information, and they're not able to integrate it, and sometimes the right hand doesn't know what the left hand's doing, and it allows for potential tax evasion. So the second pillar that they identified is core taxpayer services and enforcement. And this is technology, this is more internal for the IRS. They're utilizing software and technology to integrate the data for real-time viewing of data as they get it. They're trying to automate processes, automate manual processes, anything that they can do to update the data in their system faster so taxpayers and practitioners can view it in near real time. Presently, the IRS is using a sophisticated return review program to identify potential identity theft. They may hold somebody's refund. They may send a letter advising that we're holding your refund because of identity theft concerns. There's various forms that you have to fill out. But once you establish that there's no identity theft, then they'll release the refund to you. But this is all because of this the system that they're using, the return review program. The third pillar is modernize IRS operations. They're using innovative technologies and processes like the cloud, agile, DevOps, application programming, robotic processes, and artificial intelligence. They're doing this to recreate their infrastructure, to set them up properly for the future and to get rid of this old technology that they're constantly updating and having compatibility issues with that have cybersecurity vulnerabilities. The last pillar that they identified, the fourth pillar, is cybersecurity and data protection. And it's still kind of vague how the IRS is planning on doing this, but the plan is to protect taxpayer data using advanced analytics and tools and to align the government-wide cybersecurity standards and priorities. The IRS hasn't always done a great job of protecting people's data. In 2016, there was a data breach with taxpayer transcripts. The breach affected over 3 million taxpayers. In 2017, identity theft allowed hackers to steal an estimated $30 million by filing fraudulent returns. They used the IRS data retrieval toolkit to gain access to personal information of approximately 100,000 students who had filed FAFSA applications. The thieves used the information to file fraudulent tax returns. In 2018, the IRS's data security systems and policies have come under scrutiny. They've been criticized for being lax, and the IRS has been criticized for failing to react and respond to data breaches. So this is a constant issue. It's going to be a hot topic in the future, and it's going to be interesting to see how the IRS balances this with access to information through mobile devices and making information more easily accessible to tax practitioners and taxpayers. Included in the plan is a $99 million contract with Planeteer Technologies to develop artificial intelligence so that the IRS can more efficiently detect assets, so the IRS can more easily detect fraud, hidden assets, money laundering, identity theft, and other noncompliance. In the past, instances of tax-related criminal activity had to be manually discovered by revenue agents, which could take days or weeks, a losing strategy for an agency that has seen nearly $1 billion in budget cuts since 2010. Artificial intelligence will be used to successfully identify instances of fraud and illegality before financial losses occurred. In one IRS study, AI technology spotted 296 suspected fraudulent returns claiming nearly $1.3 million in refunds or credits. 84% of these returns had not been flagged during manual review by agents. Using data and predictive analytics, the IRS can discover useful information about taxpayers faster and more efficiently during the audit or criminal investigation period. It's going to be more difficult for people to hide assets, to commit tax fraud, and it's going to be more difficult for people to hide cryptocurrency transactions, excuse me. So the IRS plans on using artificial intelligence to mine data from tax returns, property returns, bank reports, and even social media accounts, and then to identify patterns of potential taxpayer noncompliance. So it's going to be interesting, and it's going to make it much more difficult for people to hide assets. It also appears that the IRS is interested in developing technology that will analyze user behavior to detect potential suspicious patterns, analyzing network traffic to pinpoint trends, including potential attacks and hacks, respond to and manage incidents more quickly and identify vulnerabilities in software and devices. They're interested in developing technology that will monitor social media, posts, and comments to detect threats and potential attempts to hide assets. And they're interested in developing technology that will preemptively test their systems for vulnerabilities. So it's an interesting place that we're in now, and we're in the very first year of the phase. It's going to be interesting to see how this plays out over the next 6 years, but it's definitely changing. Thank you. That's all I have today. Thank you.
So we will take another 10-minute break, which means I think we're supposed to be back here about like 15 after?